Cognitive errors are ruining your chances of trading success and you don't even know it. In this video, I'm going to bring to surface some of the most common cognitive errors and mental biases that run and ruin traders' ability to have consistent profitability and scale up with funding. I'm going to bring these mental biases to surface, show you where they impact your trading, and also share with you what you can do to overcome these biases so that you can achieve your trading goals this year. So without further ado, let's get into it. Now, the first bias or the first mental or cognitive error is what we refer to as contrast effect in psychology. This is when two things are judged in comparison to one another. Now, the most common scenario of the contrast effect in your trading is the contrast that is created between winning and losing. You see, so many traders in their mind become addicted to the pleasure or the positive aspects to winning, and they seek after winning. And they have this fantasy in their mind about winning based on what they think winning can bring them. And all this pleasure and all this dopamine is associated with winning. Now, that means by law of contrast, by the contrast effect, the moment you're labeling winning good and you're lifting it up in your mind and you're seeking after it and you're associating dopamine to it, you're contrasting it with losing and you're labeling losing bad, negative, putting it down, and associating pain substances with it. So the moment we label winning as good, we simultaneously label losing as bad based on the contrast effect of the law of contrast. Now, the issue with this in your trading is that as a trader, you're trading a probability model. Now, a probability model by definition means that you have to both win and lose in a probability sequence. So to be a consistently profitable, successful trader, by definition, you're going to both win and lose. Now, the issue here is as a trader, if you're addicted to winning or you're seeking winning or you really want to win on an individual trade and you're associating a lot of pleasure to a win, then when you inevitably experience the losses as a trader, you're going to have an extreme pain and an extreme avoidance reaction in that moment. And both the addiction to winning and the avoidance of losing is what's going to take you away from your trading plan, is going to take you away from consistent profitability. The traders that are run by the contrast effect are more likely to fall into the boom and bust cycle because they become very, very happy and proud when they win. And then because they're in this proud, invincible state, they then start to take lower quality setups and they start to take losses and have lots of pain associated with that. And they go and spiral into this negative feedback mechanism. And then they go from a boom to a bust. And they go so far in the bust cycle that they realize, shit, I need to change something. So they start sticking to high quality setups. They go through the boom again and they get so high up in the boom, they become overconfident. They start taking low quality setups. They go through the bust cycle. So what I've seen, the traders that are stuck in the boom and bust cycle are stuck in inconsistent results are the traders more likely falling victim to the contrast effect, mainly because they're so addicted to winning. And in their mind, they're just seeking after winning all the time. And you have to be aware of this contrast effect. Recognize that the more addicted you are to winning in a certain outcome as a trader, then by law of contrast, you're going to be resenting and trying to avoid the opposite. But as a trader, you don't want to be addicted to one certain outcome or trying to avoid another outcome. You want to be poised, you want to be balanced on either outcome because either outcome is possible in that individual trade, and you want to be focused on your processes. And if you want the exact tool that I teach my six-figure traders to help them get out the contrast effect, to help them get out of outcome-based thinking, it's the first link in the description. This tool will help you ground this particular bias and really all the other biases that we're going to discuss today to ensure that you stick to your trading plan and you actually build consistent profitability. I hope that makes sense, but I want you to be aware of contrast effect and realize that you can't escape it. It's one of the laws of the human psychology. Now, the second bias is what is referred to as the self-licensing effect. And this one is defined by social psychologists as an increase in one's self-image tends to make them worry less about the consequences of further actions or the next actions they take. For example, you follow your gym program and your diet program to the T for a week. And then on the weekend, you then justify eating crappy food, eating unhealthy food, drinking, doing all these things because in your mind, it's okay because I followed my training program for the week. So you lower the consequences or the risks of those actions of eating unhealthy food or drinking alcohol, etc., etc. So the self-licensing effect is going to be running your trading if you're not aware of it and you don't put things in place. For example, the most common scenario of the self-licensing effect is when you start to take a few good wins and you puff yourself up and you increase your own self-image and you start to feel a little bit proud and invincible in the market. And guess what happens? Because you're exaggerating yourself, you're then minimizing the risks in the market, and in your mind, you then justify taking a lower probability setup. You justify taking a setup that isn't quite part of your plan, but because of that self-confidence in your own self-image, the pride, the self-exaggeration, then you force a low quality setup, and as a result, you go through the boom and bust cycle again. So understand that transcending the boom and bust cycle is very much about understanding your psychology, about understanding cognitive errors and learning how to transcend them. And again, the tool that I teach my six-figure traders will help you overcome this particular bias. But also understand that you need to have a profitable trading plan and profitable edge in place in the first place. And you want to make sure that you double check your edge, you have each component of your edge clearly laid out, and you're certain that that's going to yield you consistent profitability based on previous market data. And then you want to work on your psychology to ensure that you stick to that. Now, the next and probably the most common of the cognitive errors, and really confirmation bias is the main bias that a lot of the other biases come from. But confirmation bias is, by definition, the tendency to search for and favor information that supports one's prior belief. And one of the most common scenarios I see traders falling into this particular bias is just before they take a trade. And what happens is they create this idea in their mind in the virtual market about what they think the outcome of the next trade is going to be. They're looking at euro dollar or they're looking at a particular stock, and they're saying in their mind that my belief in this scenario is that this stock or this FX pair is going to get to this particular price, and they plant that belief in their mind. And then by definition of confirmation bias, they then only let in information that supports that belief or bias. And they also, through disconfirmation bias, they block out anything that runs counter to that belief or bias. So think about what you do here. You create this belief in your mind in the virtual market for whatever reason, and then because of confirmation bias, you can't actually take in and give any significance to information that runs counter to that. Even though the market may be communicating to you that something's changed or there's a different risk here that you didn't consider prior. But because of confirmation bias, you don't listen to that. And so traders fall into this trap, and usually what happens is they then take a significant loss before that bubble is popped and they realize, shit, what did I just do? Right? So as a trader, you have to be aware of confirmation bias. It is one of the main biases of the human psychology that is going to impact your trading decisions. And as a trader, you have to do a few things. Typically, one of the best and easiest ways, not easiest, but the best ways to break confirmation bias is run a double blind test. And this is quite common throughout most scientific practices. But something you can do is you can take your current trading strategy, which you know has an edge, and what you can do just for a moment is become a devil's advocate to your own trading strategy. And you can go into the markets with your current trading strategy and backtest the past 3 months. But instead of trying to find why your strategy will work because of confirmation bias, go and find every reason why your strategy won't work. Go and find every risk, every flaw, every issue with your current trading strategy. And what you're going to do is you're going to run a double blind test. You obviously know your trading strategy is profitable, but you're also going to bring to surface places, risks, scenarios where your trading strategy doesn't work. And then you can plan and prepare contingencies for each of those scenarios. But what you do now is you have a more balanced and realistic view of your strategy because you're not run by confirmation bias, and you're a more prepared trader for the future. And a lot of traders, a lot of my students have done this, and they found that, you know what, in certain market conditions, my trading strategy performs very, very well. But then in this market condition, when it becomes a little bit choppy or the market moves a little bit sideways, then my strategy, my entries don't have as high of a strike rate, or I can't target certain risk to rewards that I was targeting in the trending market. And they make adjustments as a result. They risk less, or they lower their risk to reward as a way to compensate for where their strategy may not be performing. But a lot of the times when you're backtesting, you can't see that because you don't take into consideration all the factors. Okay, so be aware of confirmation bias. Confirmation bias also runs and has an impact on your trading decisions just before you take a trade. So that tool, the tool I teach my six-figure traders, the Bulletproof Your Mindset tool, that will help you ground and get rid of confirmation bias before you take a trade. So what you're doing now, you're not caught up in your own expectations and fantasies in the virtual market, but you're listening to the market, you're present with the market. And if the market communicates something to you that something has changed in this moment, you can then listen to that and make decisions accordingly, which is what the best traders do. So if you haven't downloaded that tool, jump in the description, download it. It's going to be useful. Now, the last little bias here that I wanted to bring to surface is authority bias. And by definition, authority bias is having unreasonably high confidence in the information provided by a person of authority. And I see this very common with people in certain trading communities, and their mentor tells them something, they just take their word for it. Now, this is not a slander at any community or any mentor. Again, I'm a big promoter that you want to learn from someone who has experience and knows what they're doing. You want to stand on their shoulders. But in saying that, always have a healthy level of skepticism and never take someone's word for it. Always do your own testing of the information you learn. At the end of the day, nobody out there can predict what's going to happen next in the market. The only thing that's going to give you an insight into what's going to happen next is the market itself. So every piece of information you learn, every insight you learn, even from this YouTube channel, go and do your own research on it. Do your own due diligence. Test it. See if it works for you. Test it thoroughly and go and find out for yourself if it works for your particular situation. Don't fall victim to the authority bias, because I see so many traders that are blindly following things that don't even work. And it may work for someone, but it may not work for you. So you have to take information on board, put it in context, test it out for yourself, and then see if it has any applicable use for your current situation. Okay, traders, be aware of these 4 cognitive errors. Be aware of these 4 mental biases, because I guarantee you they're impacting your trading in some way, shape, or form, and they're quietly killing your ability to have consistent profitability. Be aware of them, implement the tools I've shared with you, and I guarantee you it's going to make a difference. If you like this video, please like, comment, and subscribe, and share this video with your trading communities and your trading friends that you know will get value from it. But thank you for watching to the end, and I look forward to seeing you in the next video.